But first, let's jump into it with our first guest, columnist and market analyst Peter Tchin, a noted authority on the subject of interest rates. Peter started his career at Bankers Trust and later at Deutsche Bank. He has specialized in fixed income investments both as a seller as well as a market maker, and is a portfolio manager at a fixed income hedge fund. During the financial crisis, he ran the United States Credit Default Swap Index for the Royal Bank of Scotland. And you probably know something about the Credit Default Swap Index if you saw the movie The Big Short. Peter, thanks for joining us.
Thanks for having me.
Let's get right into it. You wrote an article in which you asked the question, how much of the recent post-hike rally was short covering and investors buying into a Goldilocks scenario? Can you talk about what you meant by that?
Yeah, I think what we've seen is the Fed hiked on March and short-term interest rates went higher, but by and large, longer-term interest rates, so let's focus, say, on the 10-year Treasury, it got as high as 2.6%, but it's at 2.4%. And there's a belief right now that we might be in this good part of the economy where growth is good, it's reasonably strong, but it's not so strong as to scare the Fed. So we can actually get growth without being forced to slow down at the front end via the Fed. And that would be the so-called Goldilocks economy.
Okay. What do you think about what's going on with long-term interest rates? Long-term interest rates had a nice jump, about 100 basis points or so, right after the election. And since then, if anything, the trend has been slightly downward. As you mentioned, it was kind of surprising that the Fed raised rates a quarter point, short-term rates, but long-term rates since then have actually come down a bit. So are you concerned, as I am, that long-term rates might act as a governor, kind of sort of, to prevent the Fed from being able to raise short-term rates much more?
Yes, because I think we can all agree that the Fed really is on message. They want to raise the front end and they want to raise those short-term rates. At the back end, with this longer-term Treasury, it's not budging, and it's a growing concern to a lot of people because it's almost like the bond market is telling you something different than the equity market. The equity market seems to want to go higher, seems to want to believe the growth story, and yet there's that 10-year bond market that seems to be saying, hey, maybe this growth isn't really coming. Maybe we are once again due for some sort of pullback. So I think that's concerning, and I would be much more comfortable seeing yields rise, showing growth and belief in the future, rather than this ongoing concern.
And that is a concern because do you believe what people often say, that the bond market is smarter than the stock market in terms of predicting economic growth?
I think there's a different profile for a bond investor. If you spend your whole life, in the bond market, all you ever really plan to get is the money you gave. There's no real upside, and yet if you don't get paid, there's a lot of downside. So I think we're trained to look at the downside. My only hope here is that people have been trained so long, the past 8 years, to always see the downside and then being rewarded. Maybe the bond market, we're getting too pessimistic and we're actually ignoring some of the real signs of growth and optimism that we should be having.
Okay. So, but how can long-term rates go up at a time when, the 10-year Swiss bond is slightly negative? Even the 10-year Italian and Spanish bonds are paying less interest than ours, and theoretically at least have a much higher risk of default. So in a world economy, don't some of those interest rates act as kind of sort of a governor that keep our long-term rates from getting much higher?
Yeah, I think that's really important to note because the short end is what the Fed controls. The Fed can raise and lower that and it will respond as it should. The longer end's tricky. You've got the European Central Bank continues to do this QE, or quantitative easing, so they continue to buy bunds and the Italian bonds and French bonds, and that drags their yields lower, and that causes foreign demand for our bonds. So it's definitely skewing our interest rates, and I think that's another one of these problems that we go through. Is they did all these alternative financial policies to help us through, and now we're mired in some of them. We're no longer buying treasuries, but the Fed still has, I think it's $5 trillion of treasuries and mortgage backs on their book. Germany, or the ECB, is still buying bonds. The Bank of Japan is buying bonds. So they've distorted this free market picture. I think that's troublesome, and that's another reason it's taking us so long to get a true picture of, hey, what's the growth and what are the risk and risk-reward incentives for people to take?
It's funny, everybody thinks that quantitative easing ended in October of 2014, but you're absolutely correct in that all we did was stop buying more bonds. The Federal Reserve stopped buying more bonds, but they haven't unraveled yet because the bonds haven't matured, nor have they sold them back on the open market. So, Peter, please stay with us. We need to take a commercial break. We'll be right back. And for those of you at home, please stick around too. We'll cover a lot more about interest rates. You're watching The Income Generation. Welcome back to the show. We're here today with interest rate guru, Peter Tchin. Peter, thanks for staying with us.
Yeah, thanks for still having me.
Now, you know, of course, Janet Yellen wants to raise short-term rates. So she has more ammunition, more bullets in her gun, so to speak, whatever you want to call it, next time we get into a recession. But the question is, how important do you think it really is for her to be able to raise short-term rates? At the end of the day, short-term rates went from 5 down to 0, and we were barely able to get the economy moving. So is it really that important, or is the Fed going to have to rely on other strategies next time we have a recession to get the economy moving again?
I think they're going to have to rely on other strategies. We should be, in my opinion, we should have already moved to higher rates. We should be at much higher rates. I think the economy can function with higher rates. And the fact that we're so low really gives us very little, window of opportunity if we have another problem. If there is some sort of a pullback, whether something we do or something the rest of the world does, they don't have much ammunition. 3 rate cuts isn't going to do very much. So they are going to have to, do alternatives, and whether it's QE or even beyond that. And that's something I'm uncomfortable with. I think, one real concern I have is central bankers seem to love this idea of negative interest rates. You see it still in Europe, you've seen it in Japan, and I think negative interest rates are one of the worst things that can happen. Clearly I'm not an economist, and so I don't buy into that. I just see what happens in the real world. I would love to avoid negative interest rates. I think that's the direction we head next time, which scares me.
It scares me also. I completely agree. And for our viewers, you start talking negative interest rates, it's like a 10-year Swiss bond right now, where literally for the Swiss government, for you to lend money to them, you're literally paying them a little bit of interest every year for 10 years. You're making nothing and you're paying. I want to change topics for just a little bit, though. I agree with you completely, Peter. But since you're the credit default swap expert, you helped create that index with the Royal Bank of Scotland, I really want to pick your brains about this, because that credit default swap problem was one of the things that really helped the economy and the financial institutions and really started the financial crisis and helping things cascade downward. Have we regulated those? Have we really fixed that problem? Or is that still, in a way, a smoking gun that's lingering out there?
I think we've done a decent job. What the government tried to do through Dodd-Frank was they tried to put a lot of these things on an exchange, so there's much more clarity between who the buyer and seller is, and it's more centralized. They've also reduced the amount of leverage that's available for these types of products. So I think it's reasonably controlled. I do think that given the amount of problems, and this really started with Bear Stearns back in 2008 when JP Morgan was forced to rescue Bear Stearns. There were known concerns about the counterparty risk, what was going on in the default swap market, and yet it took years and years for things to come in place. I think it's most of the way there. It still could be better.
Okay.
And
so are you concerned?
As a whole, that's not where the next problems.
Are you concerned, Peter, then that if President Trump goes in the way of deregulation, that maybe we can undo some of those safeguards that have been put in place?
I think when he looks at deregulation and getting rid of some of this, I think they should pull back on things like the Volcker Rule. To me, the Volcker Rule doesn't solve anything. Banks making markets and trying to provide liquidity for customers was never where the problems were. Traders run those books with reasonable risk limits. Sometimes they lose money, but they're never going to lose much money. It's not going to bring down a bank. So things like that were kind of thrown on haphazardly and actually have hurt the overall market should be repealed. But I do think there are some things that really go to the health and safety of the economic system, and they should be careful to make sure those stay in place. So it's going to have to be a very thoughtful look at what went in with Dodd-Frank that's good and trying to keep it, and looking at some of the stuff that was over the top, isn't helpful, and pull back on those.
Okay. Now let's talk about something that's directly tangible to our income generation members, our viewers. I get really concerned with a lot of the financial advisory world that offers fixed income, they offer bonds, but they still trust the rating services. And of course, in the movie The Big Short, you saw the famous scene where, they came in and said, "Why are these still AAA rated?" And the lady sitting there at the desk said, "Well, because I have to feed my family," and they can go right down the street and get a AAA rating from the other service. Do you think that the rating services have tightened up enough, or do you share my concerns that they still need to tighten up a little bit more when it comes to valuing the ability for companies to repay bondholders?
And I'm a big fan of, you really, I think, want some outside help with this. And really, I like the idea of even mutual funds or to a lesser extent, but also even ETFs. But I think you want an outside manager really kicking the tires. I think the rating agencies, particularly for corporate credit, so individual companies, the Gs of the world, do a pretty good job on it. But still, I think you would like someone who does nothing but look at this all day. Because again, as we spoke about earlier, from a bond investor standpoint, your big risk is losing your money, not about getting it back. So I like the idea of having people kick the tire for you. So I think you should incorporate outside money managers in your fixed income because you want that extra level of care taken.
Wow, that's almost like I paid you money. For our viewers, I want to let you know that I did not pay Peter any money to give that commercial for our company, Sound Income Strategies. But Peter, you'll probably be happy to hear that I hardly even consider the rating services ratings. To me, whenever we look at fixed income, we go right to coverage ratios and the numbers behind it.
That makes sense, because when I'm talking to my institutional investors, rating rarely comes up.
And that's right. And the ratings are important for the reserving requirements for financial institutions. But for your average investor, it's not so much the letter rating. They just want to know that their money's protected. This company can pay them back. So anyway, Peter, thanks so much. Time flies when you're having fun. And unfortunately, we are out of time. But thank you for being here today.
Great. Thanks for having me. This was fun.